Polygon acquired CoinMe and Sequence in a $250 million deal to become a US-regulated payments platform. That kind of capital deployment signals a major strategy shift. Instead of just being a general-purpose blockchain, they're now doubling down on payments infrastructure. So this video is brought to you by Polygon. Let's walk through what they're building and their ultimate goal of moving all money on-chain. Before getting into the payments play, it's worth understanding that this has been over a year in the making, and underneath it sits almost a decade of battle-tested infrastructure. Polygon chain has processed over 6.4 billion transactions since launch, with 1.4 billion of those coming in 2025 alone. Daily volumes now regularly exceed 5 million transactions, with spikes above 10 million, and the network has maintained 99.99% uptime throughout. Which brings us to the actual opportunity. Traditional cross-border payments look very different depending on where you're sending money and how you're sending it. Swift wire transfers typically take 1 to 5 business days to settle, and costs vary. On average, globally, sending remittance costs around 7%, jumping to almost 9% for sub-Saharan Africa. The real cost is the opportunity cost of capital. When a business waits 3 days for a payment to clear, that money is trapped and it can't be reinvested or deployed anywhere else. These legacy systems weren't built for the internet, so you can't program or automate them. They shut down nights and weekends, process everything in batches, and every delay means more working capital sitting frozen instead of actually working for you. That inefficiency runs through a massive market. The global payments industry generates 2.5 trillion in annual revenue from over 2 quadrillion in value flows, and cross-border payments alone are projected to grow from 195 trillion in 2024 to 320 trillion by 2032. Whoever manages to fix these problems stands to capture a piece of that. Stablecoins are making the case that they can. Transactions settle in seconds instead of days. Fees drop to fractions of a cent, and the network runs 24/7, 365. Stablecoin volumes hit 27.6 trillion in 2024, surpassing Visa and MasterCard combined, yet they still represent a fraction of global money movement. The gap between where stablecoins are today and the size of the markets they're going after is the opportunity. But capturing it means bridging what's technically possible and what enterprises can actually deploy. Building on stablecoin rails today means integrating settlement infrastructure, fiat conversion, wallet technology, cross-chain capabilities, and compliance tooling, often from 5 or 6 different vendors. That complexity is what stops most enterprises from adopting blockchain rails, even when the underlying technology works. And that is the gap the acquisitions Polygon made are designed to close. CoinMe brings money transmitter licenses across 48 US states, and obtaining those independently takes years and costs millions. The acquisition gives Polygon direct, compliant fiat infrastructure. CoinMe also operates over 50,000 retail locations for cash to crypto conversion, along with enterprise wallet infrastructure and APIs. Sequence provides the wallet layer and handles cross-chain transactions. The infrastructure lets companies offer embedded wallets without building from scratch. They've worked with major companies like Google, Ubisoft, and Take-Two, to name a few. But even with compliant fiat rails and embedded wallets, you still hit a wall if your users or their money are on different chains. Fragmented blockchains have long been a barrier to mainstream adoption. An end user or a business owner shouldn't have to worry about which chain is used for settlement. So that is where Egg Layer comes in, Polygon's protocol that unifies liquidity and settlement across chains so that global payments function as a single network. These chains are already connected, and as part of the Sequence acquisition, Polygon picked up Trails, an intent-powered orchestrator that can move any token across any chain in one click. Trails has already processed over 10 million transactions since launch. Add compliance infrastructure for identity verification and you get the full picture. Fiat conversion, wallet infrastructure, cross-chain movement, compliance, and settlement through one integration. This is the vision of the Polygon money stack. Everything you need to move money as one unified product. Now, is it all live? Not yet. The stack's first layer, Polygon Chain, has been running in production for nearly 6 years. Egg Layer and Polygon Trails are both operational, with major improvements coming this year. The Sequence acquisition closed in January. The CoinMe acquisition is expected to close subject to regulatory approvals, but the complete integrated offering, what Polygon calls the open money stack, is still being built. This vertical integration strategy is how Polygon aims to differentiate against other blockchain networks and payment providers. For example, Solana optimizes for settlement performance with sub-cent fees, but enterprises using Solana still need to source their own licensing, fiat conversion, wallets, and compliance infrastructure separately. Stellar and Ripple operate as settlement protocols, targeting cross-border payments with fast settlement times. Ripple has partnered with over 300 financial institutions, though it's worth noting that most of those partners use the messaging infrastructure rather than XRP directly for settlement. Both networks function as settlement layers where enterprises still need to source licensing, fiat on-ramps, and compliance tooling on their own. Polygon's differentiation is vertical integration combined with the broader ecosystem, access to on-chain yield, tokenization capabilities for real-world assets, and integrations across thousands of apps, and critically, integration with traditional money rails. Businesses can use blockchains today to solve most of these problems on their own, but building into legacy systems is the hard part, and that is what this stack is designed to do. But vertical integration doesn't mean that you are trapped in one ecosystem. The stack is called open for a reason. Enterprises using it have the flexibility to pick whatever they want, including which chain to use for settlement. Want to use Polygon's infrastructure for wallets and compliance, but settle on a different chain? Well, you can do that. The pitch is one solution that makes crypto integration easy without forcing you onto Polygon's rails exclusively. All of this activity flows into Polygon's token economics. POL is Polygon's native token used for transaction fees, staking, and governance. The connection to payment volume runs through the burn mechanism. Transaction fees are partially burned, permanently removed from circulation. Higher transaction volume means more fees collected and more POL burned. At peak activity, the network has burned roughly 3 million POL per day. Annualized, that represents approximately 3.5% of total supply being destroyed, more than double the 1.5% created through staking emissions. POL is also designed to function as the egg layer token, and this expands the revenue surface for POL holders once fees are introduced in future for connected chains. The economic model depends entirely on sustained transaction volume. If enterprise payment adoption grows and Polygon captures meaningful market share, the deflationary mechanism compounds. And that is just a glimpse into Polygon's mission to bring all money on-chain through their open money stack. The stack is rolling out in phases, and while it is still early to tell how this approach will compete, Polygon is betting that businesses want pre-integrated, interoperable components rather than building everything from scratch or stitching together incompatible pieces. But open infrastructure only wins if it works in practice. Polygon now has the missing pieces to prove that integrating these acquisitions creates something meaningfully better than the alternatives, or better than enterprises building their own stack. So, do we think they will pull it off? What do you think? Let us know below.